A lot of the time on my comments, people always say, okay, well, what's the rate? And my answer is, it depends. What's your personal info? So let's talk about like what actually is broken down and what impacts what your rate would be. By the way, if we haven't met, my name is Chelsea Winstead. I'm a mortgage broker and a home financing strategist. I help people in 49 out of 50 states on this app every single day learn how to buy homes, what's realistic, what can we do, and to create a strategy actually based on where you live in the country, because every pocket, like different states, different cities, different homes, there's a different strategy that I would recommend honestly for each and every one of you. But the biggest question that I get on here constantly is people go, okay, well, Chelsea, what is the rate today? And the reality is that the rates that you see, they're averages, and the truth is that your rate is going to be custom to you. There are a ton of factors that go into what rate you are going to be personally given. So I want to talk through that. However, I did want to share the website that I always go to and that I have like bookmarked is mortgagenewsdaily.com. You'll see like averages, but like here's the thing, averages don't tell you the story of what's going on, right? So let's say like, if you're getting a conventional loan and you're putting 3% down because you're a first time home buyer, I will almost guarantee you are going to have a higher interest rate than somebody who's doing a 30-year conventional loan, but they're putting 20% down, right? So the truth is that interest rate is really indicative of how a bank looks at you and how risky you look to a bank. Risk is going to be divvied up into a ton of different categories. And I actually made a list that I wanted to walk through today to give you some like behind the scenes on this, because I don't think people understand this, right? Like if you are buying a home and you have friends buying a home, it's really common to be like, oh, well, like my friends just got a rate for this amount. So like, why isn't mine that? Well, I'll tell you, it's because you and your friend probably have different financial scenarios, and those are taken into account. And that is actually what is going to implicate you and what you're going to get for a rate. So let's kind of dive into this. I'm going to go through a couple different categories. And so just keep this in mind. So number one, lenders, we don't just look at your credit score, but we look at what is like made up of that score. So think of like, if you have big revolving balances like credit cards, this is actually going to like hit you differently than if you have an installment debt, which is a car loan, right? Also, if you've recently opened new accounts or consolidated debt, there's like things that we look at. So debt type actually is something that is considered and that is factored into your rate, right? So if you have tons of credit cards with high balances, that is going to have a different risk from a bank than let's say you have one car payment at $350 a month, which is an installment, which then in theory is going to be paid off. So one thing to consider is your debt type and your debt mix. Another thing that is considered is the property type. Okay, so condo versus multifamily versus manufactured. Each home type comes with a risk adjustment. So like as an example, condos can especially be tricky and they can trigger higher rates sometimes if they don't meet certain like warrantable criteria. Also 2 to 4 unit homes often cost more to finance than single family property homes because of the risk associated, because you are sharing walls with someone. So yes, you might have a great credit score. However, depending on the property type that you are buying, that can then have an impact. So like if your friend is buying a single family home and you are buying a condo, and your condo, there's a lot of other people that you are sharing walls with, technically there's a higher risk associated with you being attached to other people, right? So often that isn't reflected in the rate that you're getting. I've kind of mentioned this, so it's kind of like dig into it. Credit score is a huge element to this, right? So yes, you and a friend could have the same credit score and you may get a higher or lower rate than them. There's often then it's, what does your debt look like? What is that score like consisting of? What type of home is it? What's your down payment? But like specifically, your credit score does have a major implication. So if your friend has a like 740 and you have a 690, you will be seeing different rates. Only caveat, specifically conventional is going to be way more sensitive to that. VA, not as sensitive to credit score. FHA, there is a difference, but it's not as severe as conventional. But, just know that like credit score does play a huge factor into this. So if you are asking, okay, well, what are the rates today? If you're below a 740, then I don't know that I would recommend that you go conventional, because the rate that you get is not going to be the same that somebody has at a 740 or higher. Okay, let's talk about down payment. This one is one that, a lot of content that we see right now, and I see it, I would actually say the bulk of my buyers right now are not putting 20% down. 20% down is a bit of like our parents have told us this. The reality is that the reason that 20% down is like a golden nugget is because when you're doing a conventional loan, you no longer have to pay for mortgage insurance. Okay, so if you are like a VA buyer, this doesn't even apply to you. But if you are someone who's not eligible for a VA loan, 20% down is like the telltale like story of when you're buying a home, you want to save 20%. It's because you then do not have to pay mortgage insurance. I can do another video if you guys are interested in like what mortgage insurance actually is for. But so the truth within this though is that today, because home prices have gone up so high, people, it's much harder to save for 20% down. So if you're a first-time home buyer and you're getting a conventional loan, you can put, 3% down. If you're an ongoing buyer, you can put 5% down. But the reality is that there are pricing and rate thresholds based on the percentage that you're putting down. So yes, I approve people every single day that put the minimum down 3 or 5%, but the more you tend to put down, the lower your interest rate is. Reason being is it's a risk game. So like I'll explain. So there are big thresholds that happen at 5, 10, 15, and 20%. The biggest improvement in rates actually tend to happen when you jump from when you basically go over 10%. So anything below 10% is kind of treated the same as far as like rate goes. But when you go like from below 10 to between 10 and 15% down, there's a big improvement in rate. So like keep that in mind. Now from 20% to 25 to 30%, you'll see some small rate improvement, but like not as big. But here's the flip side to this. So more cash doesn't necessarily always mean less risk on paper. So if you are draining like every penny of savings that you have to get to 20% down, what's called your reserves, because that's another thing that's considered when it comes to your rate, is how much money do you still have left over after the transaction. So if you're draining your entire savings account to pay the 20%, the fact that you've now emptied out your reserves may now actually hit you with risk on the reserve side, because when a bank looks, they're like, okay, this person has like a month's worth of savings set aside. That's actually a little bit risky, even though they are putting 20% down. So like there's all of these like moving aspects that come along with interest rates. So like as an example, there's like a borrower with 10% down and with 3 months of reserves can often actually get better pricing than somebody that puts 20% down but has no reserves left, because reserves is also a component of risk when a bank is looking at you being financially able to afford a home. On the flip side, so like as an example, your loan to value loan to value is how much of the home you are financing based on the value. So like, let's say that your credit score is 740, but you're putting 25% down, you actually may get a better rate than somebody who has an 800 score, but they're only putting 5% down, because the equity that you are putting into the transaction is higher, which then means that you on paper are less risky to default in the bank side. So as you can see, as we're 8 minutes into this video, there's no like secret website that's just going to give you what your score is going to be. Like you genuinely have to work with a mortgage professional to run your specific scenario, right? Like what's your credit score? What's your debt to income ratio? What is your debt actually made of? How much money are you putting down? How much money do you have in reserves? What is your actual score? Where does that land on the threshold? So this is more of like a FYI. If you're buying and you're going to websites and you see, oh, like here's the average and your rate that you're getting is not that, don't get pissed. It's just likely because your scenario is different than the one on average that you're seeing. I think also this is like the stuff that people don't talk about, right? Because this is like not the sexy stuff. Everybody wants to say, oh, rates are dropping and everything's getting so much shiny and better. Are rates dropping? Yes, absolutely. Am I helping a lot of people who have been on the fence for a hot minute because they felt like it's too expensive and now they feel like is the time to move forward? Yes, absolutely. But I do think that there needs to be like a little bit of a reality check. When you go to sites like this, I almost always find that these are off and they're not always super transparent. A lot of the time too, these rates are with people paying for points. So they're actually paying money to lower the rate that they are locking in. Well, they don't tell you that, right? So there's a lot that goes into this. And the reality is that you are not going to know what your personal rate is going to be until you work with a financial professional, mortgage professional, to tell you exactly what that is. So if you are interested in knowing what you would be qualified to purchase, to stick within a monthly payment budget that you care about, and to know what factors you are like being essentially judged on for your rate, we should have a conversation. Just as a